So first of all, like, from yesterday's thing, what are the questions that you've got? We saw lots of things. Did you get the program? I got an undelivered mail. I sent a mail, but it came undelivered. So it's the MSC MSCFE 2020 at gipe.ac.in, right? Is that the address?
Yes, sir.
Is there a way to post files on the chat? Maybe I'll just try to see if files can be posted here, uploaded here on the chat. Do you know if I can get the files here?
Not really, sir. I don't think that's possible on Google Meet.
Okay.
So
But
then
how will
maybe
you
you
get?
can just email it to one of us and we'll forward it to
Yeah,
WhatsApp or
Ali, what is
something.
your email ID?
Yeah, I'll put it on the chat box.
Do you guys want to reconvene? I mean, because this is quite, we are going towards, like as I mentioned, we are going towards a peak of, what we discussed yesterday. And, people will just miss it. That's my only concern. I mean, it's right now it's 9:44. Do you think people will join? Ali, I sent it to you. Do you have it now?
I'll just check my email, sir.
Yeah.
But I feel we should continue, to be very honest, sir. But again, it's up to you because you know how the delivery is going to be, right?
Yeah, sure. So, Ali, why don't we start with you? And I want to go because this Muskan, Jaideep, Himanshi, Ali, Cherry, Shubham, Ayushi, and two more. So, I think Neil has just joined. So why doesn't can one of you summarize what we discussed yesterday?
So, like I said, I had to leave the session midway
No.
yesterday.
So one
Yeah.
of you, like there's Neil also, and there's others also. I would like one statement from each one of you. That will make the class interactive.
Sir, can I go?
Yeah, Mihir, please.
So we learned about option pricing model
Right.
and the role of calculus in calculating the how should I say, value of derivatives. And so that's it, because the rest of it was too mathematical for me. I don't have a mathematical background, but I understood what you said about what you taught us about options and derivatives, sir.
Okay, can somebody go after Mihir?
We saw how the use of calculus evolved over time and how different people at different points of time evolved the study to understand the models better.
Muskan, Jaideep, Himanshi?
So
So
you
we have
also
also studied about the log normal.
Okay.
Yes, sir. Where
Yeah,
we
somebody else
actually
was saying.
get that ZT, which is a random variable, which the value of the ZT always changes. So we cannot predict the accurate, like what is the price of the stock of TCS tomorrow or some in some future time because of the randomness in the ZT.
Right. Anyone else? How did we, why did we have to, what bridges the gap between, normal Newtonian calculus and stochastic calculus?
So in Newtonian physics and calculus, everything is extremely certain and we can determine everything. But in stochastic calculus, we start dealing with uncertainty.
randomness.
Randomness. I'm so sorry.
Yeah, and what was the bridging? What was the bridge that allowed us to use some of the derivative rules in stochastic calculus? We saw Brownian motion, right?
Yes, sir. We saw Brownian motion.
So can you draw a tangent on a Brownian motion?
No, sir. We cannot.
You cannot draw a tangent. So that's why what did we have to do? There was this ethos lemma, right? Ethos rule, where what Ethos said was that if you add one more term, which is just the uh, uh, which contains the mu, that is the expected return, and the sigma, that is the volatility or the standard deviation, you can then start to do differentiation, right? I mean, you can then use some of the techniques. So let me now share my screen, and we can start from there. From that point on, there's a lot to cover. We also saw partial derivatives, if you recollect, right? One second, let me share my screen. Uh, you can see my screen now, right? By the
Yes,
way,
sir. It's
Ali, did you
visible.
receive the thing?
Yes, sir. I've shared it also.
Yeah. So it has got two programs really, and those two programs are uh, one is just to show how random walks are. As I'm speaking, can you try to load those programs?
Sure, sir. Will do.
Yeah. In Jupyter, I think you'll need Y finance. So what you can do is go to Anaconda, like I do here. See, you can see my screen, right? So you can go to Anaconda, the command prompt or PowerShell. It doesn't really matter. You can go there and then say pip install Y finance. First do that, and then load the programs in the Jupyter notebook. So this is how you do it. I mean, I can just, because it's already installed, it doesn't really, it'll just say everything is satisfied and you're all done. Okay. Have you guys done that?
No, sir.
So why don't you do it?
We are doing, sir.
Okay. Let me know once you're done. Anybody facing problems with Y finance? Hello? Anybody home?
Very aware, sir.
Yes, sir. Just give us 1 second.
If you don't mind, can I request one thing? Like if one of you at least, in the class, while the class is going on, put your video on so that I know that somebody is there. Thank you, Neil.
No issues, sir.
I'll have to see you this way. Thank you. Keep on doing what you're doing. See, I think there's more people who joined. What we really discussed yesterday was that some of the underpinnings. I saw your course is masters in computational finance. So if I were to take a course on derivatives, and if I was asked to tell with you or share with you what is partial derivatives, then I would actually first start with what is the normal calculus, and then the stochastic calculus, because Black-Scholes is based on stochastic calculus, right? So and what we discussed yesterday was in normal calculus we did a bunch of things, simple derivatives, integration, and in stochastic calculus, since there are random variables, what we had to do was we had to use the rule or ethos lemma, which is there in this screen here. This is the standard calculus. Whenever you are doing a derivative of a function, which is we wanted to. I mean, why are we doing this? We are doing this because we want to find a derivative of a call option or a put option. And what is a derivative? Derivative by definition it has got like itself as the security, but it is based on an underlying security, right? So this f of the derivative function, let's say the call option price, is based on an underlying security, let's say the stock price. And the stock price itself is, it's a function of, it can't be, I mean, one way to look at it is that it is a function of time. So if you want to take a derivative of this, and why do you want to take a derivative of this? Because you want to know what are the effects on the changes in the option price, right? You go to the market, you ask somebody, I want one year forward 1 quintal of sugar. That's a derivative security, because 1 year you are saying that you want something 1 year forward, and there is a lot of uncertainty. And that person who is promising, that person, they will have to find out what if they are not able to provide that one quintal of sugar. Similarly, like suppose you wanted to say, I want 100,000 TCS stocks in a year's time, but you want to have the option to buy, and you may not buy. That is a derivative security. So that's what we meant. But we have not yet said that this is an option. I'm just saying, like, there's a normal function, and if you wanted to take a derivative of the function, and why did we take derivatives? I think some of you agreed yesterday that if you wanted to go down a curve, or if you wanted to find out the rate of change, then we need a derivative. So if you wanted to know the rate of change of a call option price, we need a derivative. And what we do here is we take the derivative of, so this is a simple, since it's Newtonian calculus, this is a simple, partial derivative with respect to time, partial derivative with respect to x, and into the partial derivative again with respect to time. The problem is that the Newtonian rules don't apply, so we have to use stochastic calculus. In stochastic calculus, what happens is this term comes into being, right? We saw that this term suddenly starts to take shape. This was the term, right? Sigma T of xt dwt. Now what Etho did was, he said that, well, you can do everything that you wanted to do. So all the terms, like this term and this term, is exactly same as normal calculus. This is one extra term that is there in the ethos formula. And then the ethos formula gives us the change in the function, sorry, this is really bad. The change in the function as this value. Everybody with me?
Yes, sir. So just on a side note,
Yeah.
I'll just be the one to talk for the class, because since no one is mentioning this pip install. May I just share my screen?
Yeah, please.
Yeah.
So I have to stop sharing, is it?
You may not have to. You can just resume later on. Yes, sir. So for the pip install, do I do it in the command prompt, or am I supposed to open
No,
Python from?
go to Anaconda.
Okay, I have Anaconda open out here. So I'm not being able to type. I'm a little confused, because earlier I said
No, not there. Go to your Windows prompt, like this Windows left hand corner, bottom corner.
yes, sir.
There, type Anaconda. One second. No, can you see Anaconda prompt?
Is it this one, sir?
No, the top one. Yeah, this one.
Now I'll do it out here.
Wait. Let it come.
Yeah.
Press it. Yeah, now do it. Pip install. Y Finance.
Am I supposed to press Control Enter, or just
No, it should work.
Okay.
Unless you don't have admin access to your PC.
No, I do.
Again, I don't know what it is doing.
Neil, you can just do it from the Jupyter page, right?
I don't. Yeah, just tell me how to do it. Ali, I'll do it.
You need to. So first, what you can do is you can just load source file on Jupyter Notebook, and over there just add a cell above
You
it.
can
and
also
just
do. Yeah, you can. You're right. You can also do from the notebook itself.
Okay. I'll do it from the notebook. Okay, thanks.
No, open it so that everybody can see.
Yeah, 1 second. Just give me 1 second. I'll just do it in a new one, so it's anyway going to just download, right?
Yeah.
Uh,
Ali seems to be an expert in Python, is it?
Not one bit, sir.
What is your background, Ali?
I'm from commerce background, sir. International business.
Okay, great. So I think you'll have to do exclamation mark and pip install, right? I don't know.
Ali, if you could just help me.
Shift enter. It is running. Ali, you have installed Y Finance?
Yes, sir. I did it this way only, but without the exclamation mark. It worked fine for me.
All right. I'll just let it. Oh yeah, I think this is working.
Yeah,
So it is done.
Yeah.
Okay.
Yeah, successfully installed. Now you can run both the programs. How about others? Himanshi, Jaideep, Mihir.
Thank you, sir. Thank you, Ali.
Done, sir.
You all have installed?
Yes, sir.
It is
Completed.
installed, sir.
Perfect. So shall I continue?
Yes, sir. Yes, sir. You may have to resume presenting, sir.
Okay. So now, if you go back, so this is what we covered yesterday. So people are clear on this, right? I mean, this is what Ethos did. And, this is the main thing that came out, that if you wanted to calculate the change in option price or change in the function, which is a stochastic function, you have a normal calculus thing plus this additional thing, and then this devolves to this function, this short function. We don't need to remember the maths, but as I said, like if you go for if ever you go for a interview, and if people say that, then people ask you questions, all I want you to know is that this is the main diagram. Okay, this is the main thing. Right? This is the main thing for with regard to options: calculus, stochastic calculus, Ethos rule, and derivatives pricing model. That's how Merton, Schwalz, and Fisher Black, they came out with what they did. Okay, so let's continue now. Now, before we continue, can people run the first program, which is the random walk program, and see what is happening? I will go to the random walk program myself. So if these are my programs, and there are lots of them. Sometimes I get confused which program is what. So this is a random walk program. All it does is you all it open, right? You have it open?
Yes, sir.
Yeah. So so this library, right? I mean, first of all, like, what it is doing is this function is just creating an array, empty array, right? And I'm just calling it like price walk array. And then I'm defining the position as 0, steps as 1000. And then I'm taking, 1000 steps here. And for each step, I'm creating a random variable. And I'm assigning it, depending on whether that Boolean, it's a Boolean variable, either taking value of 0 or 1. It's like almost like a flip of coin. And if it is a 1, then it takes a value of, the step takes a value of 1, else it takes a value of -1. And my net position, so imagine that, you're playing this game where you're either winning or losing, but by chance. And your bank balance may increase or decrease. Who knows? Right? You're with me? So you and your friend, you sit together and both of you decide, suppose, Neil is there and let's say Ali is there. They're playing a game. And in that game, like, Neil is having 100 rupees in his bank account and Ali is having 100 rupees in his bank account. And Neil says, why don't you start? So he flips the coin and then Ali wins. And if Ali wins, he goes one step forward. His bank balance increases by, let's say, 1 rupee. Next time, Neil plays, his bank balance also increases by 1 rupee. But it is random. And each of them, their bank balances are different. But let's just take Ali's balance. So what will happen is that at the end of 1000 steps, my array is filled up with, positions. So these are the positions in the array. And, if you look at the values, so if I'm just saying this is a random walk. So it's a completely random walk. Are you guys able to do this, run this program?
Yes, sir.
Yes, sir.
Okay. So now I would like one of you to, change this value to 1 and then tell me, what happens in the random walk program.
Sir, I think it'll be a straight line.
Why don't you do it? You've done it?
It's a straight line.
Right. Now, if you keep on changing the values of this one, the line could get steeper and steeper depending on how you change the if then else condition. So I wanted you guys to get a feel. The second part of the program, right? Second part of the program. Now we can go and talk if you get time, but this is some nifty things that you can do in Python and you can't do it in R, or or you can, but you'll have to write a lot of things. You can say, imagine this is the bank balance. So Ali may want to know at what step did I really hit the bottom, or Neil may say, at what step did I hit the max. So you can easily use this to find out what. So first of all, you can use this to find out what are the min and max, and then use this to find out where did you get into the profit. Okay, so suppose this is the min and the min is 4, and let's say that is Ali, and the max is 40, right? So now if I want to know at what step I went more than, let's say, 20, right? So I'm getting a value of 20, and at what step did I do that? So it's 211 step. So you can see here at 211 step, I started to really climb. The second part of the program is, what I'm doing is I'm just getting the ticker, like, your favorite ticker. So if you run the program, can you try to run it? I'm just putting tcs.ns, and what it did was with tcs.ns, it created these 100 different paths. 100 different paths. And this is exactly the logarithmic formula that we used yesterday. Okay, the log normal formula. Look at what it is doing. Look at what the program is doing. First of all, I got everything. I got my last prizes, 1 year prizes. I got the 1 year prizes here. And after I got the 1 year prizes, what I did was I just did a log of thing. And then I got a return series also by just doing a log, right? So I got a 1 year return. Now for this 1 year return, I got the expected return by calculating the mu. And after I calculated the mu, what I really wanted to do is, take that piece and then, go to our formula, log normal formula. And that log normal formula uses this. And, I also got my sigma. Now, after I take this, I get everything. I get the drift and the diffusion. You can actually put the log normal formula, write it on a paper. It will be exactly what is there here. It will be exactly what is there here. Okay. So you take that and then you'll see that this is what I'm doing. I'm using that formula, the log. If you guys recollect, it is S is equal to S0 into E raised to, it is S into E0. This is the S, this is the S0, E raised to drift plus diffusion. And this is the drift component and this is the diffusion component. Got it? So drift is, it is drifting away, and diffusion is, how widespread it is. And then you can get this, and it is doing this randomly. Why is it doing it randomly? This is the randomness. This is a normal distribution with mean 0 and variance 1. Everybody with me? Any questions?
Sir, the drift is not random.
Yeah, so you saw, so where is our formula? Look at our formula. We are just blindly copying the formula. Okay, sorry, I don't know who's asked that question.
So, Cherry, I couldn't understand the drift part.
Cherry, this is the formula we are using. Okay, this is the formula we are using. Sorry, this is what I can do. So it is taking S0 and it is taking this and it is taking this. So why are we calling drift and diffusion? It's just a nomenclature. See this, there is no randomness in this, right? This part, can you find any randomness?
So, at the last, Z is the function of T.
So there is no randomness. It's all certain. Mu was there. Standard deviation was there. So there's no randomness. Correct?
So what about the T plus sigma times that ZT?
Yeah, so this is the place where we get randomness. Okay, this is the place where you get randomness. Z of T is a standard normal distribution variable, right? So that is how you introduce randomness in the function, and this is what you get. So you see, so this part doesn't have that, right? This is just a simple drift. And the diffusion part is where you get a randomness.
Okay, sir.
So there's one more question. Row 30. You've written T equals 12 by 12. Could you just explain that? I missed that part.
Yeah. So if you want to forecast 1 year, then I'm just taking 12 months by 12 months. These are months, right? So I'm just saying, like, I could just say 1.
Yeah, got it, sir.
Yeah?
Yes, got it.
Or I could say 1.5. But for clarity, so that anybody who's reading the program knows it, I'm saying 24 by 12 will be 2 years. So you can, sometimes as stock analyst or sometimes as, you want to know, this is one part of Monte Carlo actually. What is Monte Carlo? I could put over here 10,000, okay, number of repeats. I could put here 10,000 or 100,000, and I would get, those many curves here. I would get those many curves. So all it is saying is this is the possible range of values I could have. And now in this one, right? So what is the standard deviation? You can already see that this is the maximum, from this blue thing to the green thing is the maximum variation in the stock price that you'll get, right? And then each one of this will be kind of a, like if you do over here, right, this will be kind of a kind of a curve. Okay, it will be kind of a probability curve. Why? And that probability curve, what will it have? It will have a mean and a variance, right? It will have a mean and variance. So imagine that looking at it this way, right, horizontally, it will be like a probability curve. So all we are doing, guys, here is that we are faithfully, like very faithfully, we are saying that we want to just reproduce this, and that is what we have reproduced in Python. And you can be rest assured that the expected value will be this, and the variance will be this, and that variance you can see, like in this kind of a normal curve. This was your thing, these were your stocks, and this is kind of curve that you'll get. Got it?
So is there derivation for these expected value and variance?
Yeah, so we talked about, I mean, the expected value, you can
Expected value is easy to understand. The variance is a bit.
yeah, so this, how we talked about it yesterday, right? Suppose you want to do you want to find this, really, right? You want to find this. What will you do? You'll say log of st minus log of s0.
Yes,
And
sir.
since we're talking about variance, this entire thing will be 0, right? This will be 0.
Yes, sir.
Right. And now what we are doing, we are taking log of st upon log of, so we are taking variance of log of st upon this. And since this becomes square, this t goes over here, and then you get and the variance of z by t by definition is 1. So you get 1 by t into variance of log of st by s0. Got it?
Okay. Yes, sir.
So, Cherry, thank you for the question, but I think it was Cherry, right? I can't see.
Yes, sir.
But and good that you're thinking, but don't worry too much. If you start to go into maths, it can get complicated. But if you want to really aspire to be an options trader, go all for it. This has been derived hundreds of times, and the more you dig it, the more you touch it, the more you feel it, you'll become friends with it and play around with it. Actually, what you can do is you can try to take some of these strategies. I mean, there's a lot to cover today. Some of these strategies, and start trading options.
Yes, sir.
Okay, so this is Ethos Rule. We got to Ethos Rule, and now this is the Merton's derivation for this is where we kind of were at the fag end of our class, and we said that this is the change in the call option price, and this is what we got. Okay, so I think deriving this formula, there's no point really, because it's already done, and it will take a lot of time to derive this formula here in the class. But this is what it is. It is not, it is exactly, if you can see, it is exactly this. It is exactly this, right? It is exactly this thing. It is exactly this thing. Okay. So let's go on to now the Black-Scholes equation. We covered it very, very briefly yesterday. And what the Black-Scholes differential equation is really, it is saying that the partial derivatives of some terms, right? So let's familiarize ourselves with the terms first. What is C? C is the call price. Okay. What is R? R is the interest rate. What is C? S? S is the stock price. Okay. And what is rho? Sigma. Sigma is the standard deviation. What is R? R is the interest rate. C is the call price. That's it. Okay, that's it. And what it is saying is that the call option price is a function of, as a function of ST, is nothing but S, the price of the stock, and N of D1, the normal distribution of a number called D1. Okay, minus K e raised to minus RT, normal distribution of a number called D2. Easy to remember. So you can remember S minus KERT, right? S minus KERT is, remember it this way. So S is the stock that you brought. And what you did was, you bought this stock by, let's say by borrowing money. and you borrowed at the strike price, and you had to pay this as an interest, right? So this is what the present value of the borrowed money is. So remember it that way. And then what this ND1 is, ND1 is really the delta of the stock. Okay. What is the delta of the stock? Delta is nothing but this. Not this, sorry, not this. Delta is nothing but this one. The change of the value in call option price per unit change of the value in the stock price. So this is what this ND1 is. It's the probability that the call option will be in the money. And we saw what is in the money, out of the money, right? Hello?
Yes, sir.
Yeah. And ND2 is really the chance, the probability that the option will be actually exercised. So there's a battle in between when you see the call option as a battle between two things, SND1 and minus KE raised to minus RT ND2. The probability of of option going into money is scaled by the stock price, and the probability that the option will be actually exercised is scaled by the amount that you have borrowed. That's how you can look at it. And this D1, it's a little bit complicated, but you'll get used to it as you become a options expert. You'll get used to this. It's nothing but log of. You don't need to remember the formula, because the formula will all be camouflaged in a Python function or Excel sheet. This log of S of k plus R plus sigma square by 2 into T divided by root of sigma square T, or you can also say sigma root T. So these are the parts of our previous equations. Okay, these are parts of the previous equations that we have already seen, and these are repeating in a different form here. No, I mean, let's now leave that baggage behind. We have left the station. We have seen what Mr. Ito did. We have seen what other predecessors, including Robert Brown, Bachelier, and then Ito did. And then we are now making peace. We are really call it peace. We're making friends with Black-Scholes equation. Okay, accept Black-Scholes, right? Accept Black-Scholes, because these guys have created this depending on other masters who have come before them, and this is working. There is, of course, huge criticism on the Black-Scholes equation. Black-Scholes themselves, they have criticized it, including Nassim Taleb. But no matter what, you have to give it to them that they came out with this equation and they have given you something, right? They have given you something. So, for example, your parents may say the harder you study, the better marks you get, right? That's a rule of thumb. That's a model that they created. Similarly, Black-Scholes have given this model. And this model, people have been using it at least to find out whether it makes sense. Any questions so far?
Sir, can we safely say that mathematically the evolution of pricing of option will continue in the future? Like we have Black-Scholes, maybe in the future we'll have something else.
Sorry, who's this?
Sir, Mihir here.
Yeah. So Mihir, the pricing of options is constantly evolving. Like, this is the basic model, right? What you're saying is this is a basic model. In practice, there are people who, there are other complicated models that are being used. But by far, 60, 70, 80% of a basic price that an option gives, people are taking this. What really happens is that, Black-Scholes is used everywhere, in Wall Street banks also. But you have to understand, it's like, monitoring your BP, right? Or monitoring your temperature. You have to understand as a doctor, as a specialist, what does that value mean? What you really do is, as you go, we've got option strategies today. You're concerned with making money, right? Not on the authenticity of this, right? You're concerned with making money. And remember how we came to this equation. We came to this equation through the maths that was evolved in the 1800s and the 1900s. Of course, there are better equations which I am not aware of, but there are better equations. I read a paper, while I was preparing for this class, I was reading a paper which was published in the Journal of I forgot which journal, but it's a fantastic paper. It goes into complicated maths and it says this is the modification that you can do. Now, do we want to really do that in this class? No. We have to just be aware that these modifications exist. It's similar to you guys have studied arbitrage pricing theory, right? Have you?
Sir, only basics.
Yeah. Have you also studied, the Markowitz frontier, right? The efficient frontier,
Yes.
Yes, sir, we cover that.
right? So how do you optimize the portfolio? So in fact, what happens is in a Markowitz setting, you ignore the higher moments. And what do I mean by that? You ignore the higher moments, meaning if you have what Markowitz does is he's created this optimization algorithm based on lower moments, that is just the mean and the standard deviation. Okay, he's ignored the higher order quadratics that come in when derivatives are in play, or when stock prices stop behaving, they behave in a normal setting. And in fact, one of the things is that he's also assumed that stock prices are continuous, right, which they are not. So this is a big step compared to Markowitz. This is a big step where we have already said that it's a random thing. It's a stochastic calculus. Got it?
Okay, sir.
Yeah. So what we have to do is we have to understand that this is the journey so far. And if you, for example, one of you, I'm sure, will go on and do a PhD. I don't know, and you should. I encourage you highly to not just India. You can also look at aspire. Why not aspire to go to a London School of Economics, or to go to Yale and do your PhD. But you'll have to really work hard to show that what you have got is good enough material and you can take it to the next level. And maybe that could be a research topic. But right now, as if you wanted to join as
Sorry, I'm having trouble connecting to the internet. It looks like there is an issue with
Sorry,
the
that
router
was-
and echo device. So try restarting them. Unplug both of them, then plug the router back in.
Sorry, that was my Alexa.
Once the router is back on and connected to the internet, plug in the echo device.
Yeah. So let's go on. So we talked about this, right? We just said that S minus K of RT is a difference, and this difference is crucial, but it's the current intrinsic value of the option. And what is the intrinsic value of the option? We'll come to that again. But what we are really doing is, we are taking the stock price and taking the difference of the stock price, and what you would have done with the borrowed money at the strike price. Remember, we're talking call options here, not put options. And ND1 is a delta for the option, the chance that the option will be in the money, and ND2 is the probability that the option will be actually exercised. So these are just stay with them. Any questions so far? Hello?
No, sir.
Yeah. So let's go to the
So before one thing,
yeah.
sir, if the Black-Scholes model is used on some asset which the dividends are paying continuously, and if we assume and if the dividend which is received are continuously reinvested in another stocks or thing, so how would this formula would work for that?
No, this won't. Remember this, like this is the this is the assumption. So then you'll have to go to complicated maths, right? So it's there. You can just do a DuckDuckGo or Google, or do a Bing, and you'll find out a formula that will give you a option price for options that on stocks that are dividend paying. You'll also find, and remember, these are European calls. Okay, what is the difference between a European call and American option? European option and American option. European option can be exercised only at the end of the term. American options could be exercised anytime. And there are other things also. I mean, there's a host of assumptions. Sorry, who's this?
So Cherry.
Yeah, thanks, Cherry. So there's a host of assumptions. I would suggest, Cherry, that we be very, very familiar with this first, and then you can start taking small steps into what about dividends, what about short selling. I'll tell you the important ones here. So dividends is important. American, a shift to American options is important. A shift to term structure of lending is important. And that's what right now should suffice you, even as a probably as an experienced option trader. And then you can go to other complicated things, transaction costs and so on and so forth. But that's what it is.
Okay, sir.
Yeah. So let's go to now look carefully at the things that are making up the option price. This is the option price, and you can see what is it dependent on. It is dependent on the stock price. Sorry. It is dependent on the stock price. It is dependent on exercise price, R, standard deviation, time period. So how many are there? 1, 2, 3, 4, 5. Right? There are 5 things that it is dependent on. And as Cherry pointed out, like if there's dividends, we have to take care of that as well. Okay, so but these are the 5 things: stock price, exercise price, the interest rate, standard deviation, the volatility, right? This is the volatility, and the time period. So now from this you can make out, right, as the now first of all, remember this ND1 is not a simple thing. It is the probability density function. You guys are aware of what it means?
Yes, sir.
Can somebody tell me what it means? So when you get a value of D1, when you ND1 is nothing but you have to find out the probability that this value is greater than this particular number of D1. That's the probability that you have to get. Okay. So that is this number. Similarly, ND2, you have to find the right hand tail of the probability curve. Got it? Hello?
Yes, sir. Got it, sir.
Yeah. So there is there are these things, okay, and the most important is the volatility, because volatility is the life of this option. As you can see, as volatility increases, D1 increases, and since D1 increases, the chance that the option, the call option value also actually increases. Okay, so in fact there's a table that I put up. So as volatility goes up, call option and put option, both of them increase. As interest rates go up, call option increase in value, but put options go down. And as the time to maturity increases, the value of the call option as well as put option increases. Isn't it intuitive? Some of these things, are these intuitive? Remember, what is the meaning of a call option? What is the meaning we said? What is the meaning of a call option value?
Sir, it's the difference between the strike price and the current price.
Correct. But why is this logical? Why should the value of a call option go up if the time to maturity increases? Okay, forget about interest rate. Why should the call option value increase if volatility goes up?
So because volatility here would represent risk, right? So the more risk you're taking on, the more reward you would you'll actually demand more reward against this risk. So because of this volatility, if I'm selling an option, I'd like to be compensated at a higher rate, right?
You're getting there, but not yet. Sorry, who was
Sir,
that?
Ali, sir.
Can I
Ali.
try, sir?
Yeah.
Sir, because the call option is actually the holder's right to buy something, sir. So if the time go up, then it might be the case that the prices will rise to an unexpected level. So then if he buy at that time, then it will be very late for him, sir.
You're somewhat touching it. Who was this?
So Shubham, sir.
Shubham. Anybody else? There's a logical reason why the value, we are talking about value of the call option and put option, not just call option. Why does the value of this go up if volatility increases and time to maturity increases? What does the call option and call option signify? Let's say,
So,
yeah,
so option price is monotonically increasing. That could is an increasing function of volatility.
but why? Sorry, who's this?
So cherry.
Yeah, why cherry is the option price? Uh, I don't know. You use the word monotonic. I don't know whether it's monotonic, but why is call option uh, price increasing when volatility increases?
Okay, so can I give it another try?
Yes.
Sir, I'll just what I'm doing is I'm linking it to the random walk hypothesis, what we just learned right now. So the longer the time period, the higher the price can climb up, right? Because again, it's a random walk.
Yes. So you are getting there. So who is this?
Ali, sir.
Yeah. So Ali, you didn't use the word. The higher the chance, because you are giving it more time, right? You are giving, so if you are giving it more time for things to act, higher chance that actually it will go up. And there could be low, it could also go down, but it could also go up. And the probability, all things being equal, the probability that, let's say, you've got, let's say, Ali, somebody says that you have to do a PhD, suppose you have to open up a startup. The longer time a startup stays in business, the better the chance that the startup will actually make money, right? So it's the time that is there, and that time is what the call option is actually pricing. Similarly with volatility, what happens in volatility? So volatility, volatility means things are going up and down, up and down, up and down. But in this up and down business, it is going to hit sometimes up. We saw a bunch of curves that went, we saw the Brownian motion curves in the Python program, right? What did those Brownian motion curves do? So we increased from 100 to 200 to 1000 to 10,000, and we saw that one of them really hit it up, right? So the volatility has actually increased. If the volatility actually increases, there's a higher chance, there's a higher probability that the call option will end up being in money. Similarly, like if you give more time to maturity, there's a higher chance that the call option will actually increase in money. So these are like really key things. That's why, when you go to a trading desk anytime, any trading desk you go to, they will be bored if there is no volatility, because they'll not make any money at all. The Wall Street banks, they thrive on volatility. You think that, so for example, if the market is, one today up, tomorrow down, again up, again down, that means it is not a flat market. It's not a trending market. Many times markets are trending, they just go up. That is a killer for traders. Traders make money when markets are volatile. Okay, got it? Does it make sense?
Sir, can it be because options are a tool of hedging? So that is why more the volatility, more the price.
See, I mean, first of all, I mean, the dumb answer to this is that this is there in the numerator and it just increases. Okay, that's a dumb answer.
Okay.
And right, so this is a square term. This is just a, this is this is not a square term. This is like rho is over here. So the more the volatility, the better. That's a dumb answer to it. But there's an intuitive answer that I was looking for, and that intuitive answer is that volatility. I mean, intuitive meaning, look at it, right? Like, look at the option. Suppose your option, you bought an option. Let's say you are holding TCS stock, and nowadays you got options which expire in 7 days. So suppose TCS is, I don't know what it was trading yesterday night. Let's say it was trading at 3,600, and you bought an option of 3,700. So what happens is that now, as your suppose the option were to expire today, we are doing a thought experiment. If the option were to expire today, okay, 3,600, and your strike is 3,700, and the option is expiring today. That is scenario A. And somebody comes along and says, okay, the same thing, 3,600, 3,700 is the strike, but the option is going to expire in 1 month. And you, as a shopkeeper, let's say investment bank, you want to price both the options, option A and option B. Which is the higher price you'll put? For which option you'll put higher price if you were to sell? I come to you as a customer, and I tell you that you give me a quote for TCS price for 3,700 strike expiring today and expiring 1 month hence.
1 month hence, because there is more room for volatility.
Yes. So as a seller also, you're going to charge a premium for that, right? That the option may actually go into money. There's just 100 rupees, 3,600, 3,700, and there's a more chance now in 1 month's time TCS may actually cross 3,700, and I'll have to compensate for my loss. So I'm going to charge more, and that's why the call option price is higher.
Okay.
Got the intuition? That explains time to maturity. Now,
Yes.
volatility. Sorry.
No, sir, I got it. I was just saying
Yeah.
that.
Similarly with volatility, right? The more volatile it is, suppose something is like vibrant, compared to a dull stock, let's say a pharma stock, something is more vibrant, and there's a pharma stock which is not vibrant at all. So you, as a seller, as a shopkeeper, I come to you as a customer, option on this dull stock and on this volatile stock. Intuitively, what will you charge? Like, you'll be charging higher for this one and lower for this one, right?
Sir, higher premium for the volatile stock.
Exactly. Yeah. So that's what I'm saying. So that's the intuition. Okay. Apart from the formula, that's the intuition for these two guys. And similarly, you can do a think of the interest rates as well. Okay. The main thing is that the more volatile it is, the better it is for traders, the better it is for option, both the buyer and the seller, because the buyer benefits. Buyer says that, oh, I'll get into money, and the seller says, no, this will get into money, so I have to charge higher. Okay. Shall I move on?
So can you please elaborate on interest rates?
Yeah. So interest rates, what happens is, now look at interest rates, right? When interest rates go up, what happens?
So like
First of all, the
currently,
dumb thing here is this.
uh,
Remember, minus R is actually in the denominator because it is minus R. So that's a dumb thing. Now go and look at this one. So as the interest rates go up, right? As the interest rates go up, you want to be compensated as a call option seller that the interest rates are going up. Actually, as the interest rates go up, stock prices drop. Why do stock prices drop?
so valuations come down.
Sorry?
Valuations come down, sir, and
The
money in
valuations come down.
yes,
Right?
sir.
Now, let me come back with the intuitive feel for that. Park it there. But, the dumb answer, see, interest rates are, hardly for, let us go back to, where we are. We are talking about, I mean, why are these two, can somebody tell me why are these two more important than interest rates? Intuition. I'm not even going into maths. Intuition.
Sir, I'd say interest rates would not change as frequently as the other two.
Yeah, exactly. So what is going to happen is that interest rates typically are set up by the central bank, right? And the interest rates, suppose now they are set up for now depending on central bank policy, you got a base rate that is there, and that doesn't change. And the time period for this option is typically in India it is like 2 months, 3 months. Long dated options are far and few, but yes, they are sensitive to interest rates also. I just put interest rates because of this, because you got 5 different things over here. This is-
So the call option prices and stock prices are like somewhat move in the same direction, right?
So there is a you will come in the you'll come to that. We'll come to that. I mean, not necessarily. So
Yeah.
there is a actually you can practice it. Okay, so this is even better. So I've got I don't know if you have. Can you do it in practice? So you've got the formula. Can you do this in practice? So this is the TCS prices, and play around with it. I would say play around with it. Where is this? So TCS price is 3,500, strike price is 3,800, interest rate is 6%, volatility is 20%, time period is 40 days. What is the price of the call option? Actually do it. Do you want me to make things easier for you? I'll send you the spreadsheet. Shall I send you the spreadsheet to calculate it? There's no yes.
So yes, sir, you can send it.
One second. So I would like you to play around with this. And you've got like options calculators, all over the place. Okay, but let me just you can find options calculators on the web everywhere. But what I would like you to think is you should always see and change your change your things yourself. So now this is what this is not correct. One second. One second. What did I do? So be careful with the values. You're seeing my screen now? Hello?
Yes, sir.
Yeah. So this is a stock price. This is a strike price. This is the interest rate. I mean, the interest rate could be, it is not that high. It is right now something like 12%, right? You can see that, the value is very insensitive to interest rates. Although it changed from 20 to 12. And then there's volatility, but this is very sensitive to volatility. And then this is a time period. The time period is in days. So time to expiry is 15 days. There's an expiry right now, and there's 365 days. That's why it is. And then you get these values. You get see this all these expressions, and you finally get the option value. So let's say go play school. What do you call this school? Gokhale School of GI?
GIPE, sir. Politics and Economics. Gokhale Institute
Gokhale
of.
Institute of, yeah. Ali, what is your this thing? Or
So it's ALIAS. It's there on the chat box, sir.
What is your group ID? MS.
So I don't think you'll be able to send it to there
No,
because
so it was my it was not allowed from me, but
okay.
I'm using your own Gmail now. AS. Options spreadsheet. So I sent it to you to the class. I don't know if the class has got it, but can you just check?
So not yet.
But anyway, so why don't you calculate the? We are running short of time. You can do this as a homework, right? And plan that you actually actually calculate the value of this and change. Go and look at the screen. I mean, go and look at how it is being traded. So there's one good site. Where is that site? So you can India Infoline has got all this. I mean, you can go also to Nifty and NSE website, and you can find the expiry date, and you can find the screen price of the option. For 3,800, you can go down and find out what is the screen price, right? And then the screen price. I mean, this could be a sweet spot. You can find out like if a particular trader is making a mistake. Somebody is actually. So how is this price being quoted, right? Somebody is making the market. Somebody is there as a seller, as a shopkeeper. That person is saying that I sell this option to you, and you are there as a buyer. So there could be a sweet spot as you play this game. As for money, you'll find that these options are not fairly priced, all of them. People have got different inclinations. So we've talked about in this Black-Scholes formula. It's just a formula, right? It cannot capture the entire market. There's supply demand which no formula can capture. Only randomness can capture, right? So this supply demand is there. There's the expectation of volatility that is there. And through this last price, what you can also do is you can like we calculate now the price of the call option, you can go reverse. And I mean, this just you can calculate the volatility. So given the screen price of an option, what is the volatility? And that is implied volatility. Implied volatility becomes super, super important if you become an option trader. Okay. So, what is simple volatility? Can somebody tell me? What is simple volatility?
I
Sir,
think
I
the
would assume it
standard
is
deviation of returns.
Sorry?
Standard deviation of returns.
Standard deviation of returns. No, not yet. So what is the period over which you calculate the standard deviation? Sorry, who is this?
Prasoon.
Prasun, what is the period over which you calculate? How do you calculate standard deviation of returns?
So the period, I don't have any idea.
Anybody, how do you calculate standard deviation of returns?
The formula I know, but the period which we take into account, I don't know.
Formula to hai, but how is it done? What do you do? फॉर्मूला तो पाइथन में भी है. क्या होता है स्टैंडर्ड डिविएशन में? व्हाट आर यू सेइंग? वोलेटिलिटी मतलब क्या? हाउ मच इट इज गोइंग अप एंड डाउन, राइट? So
Yes,
you
sir,
take,
from the mean.
you take every value, you take the mean, find out the difference. You take every value and square it. Take every value, find out the mean, square it. Take every value, find out the mean, take the difference, square it. Do it for all the terms, right? That is and then divided by the number of observations and square root it. So that is standard deviation. So What you're really doing is you're taking every single value and seeing how far it is going up and down from the mean, and trying to get a amplitude or magnitude for that, and you get a sense of it. Now you got a sense of it when you take daily values for, let's say, 1 month, you get a daily standard deviation. Or let's say you take, for yearly values, for year long data, you still get a daily standard deviation. Now to annualize that standard deviation to the annual value by multiplying by what number? The square root of the trading days. So you annualize it. Okay. So what you really need to do is have an annualized volatility estimate. What is it? It's not a simple number, otherwise your things will go wrong. This number over here is the annualized volatility, because everything is in years. See, this is also in years, right? This is also in years. This is also in years. This is also in years. This is a yearly interest rate. Got it? Are you with me?
Yes, sir.
Yeah. So why don't you, kind of just play with this thing a bit and come back with an answer on, everything is given. Right now you are getting the option. I mean, let's say, in your spreadsheet, change the stock price to change the strike price to 3,900 and tell me what the option value is. I won't hit enter. Okay. And I'll let's see what answer you get. I'll be back in a second. Sorry guys, any progress?
So is the answer 32.19?
Yeah, should be. I mean, this, let's see. Yeah, it is right, 32.19. Sorry, who was the person who gave the answer? I mean, I guess everybody would have had an answer now.
So Cherry.
Yeah, Cherry. So, Cherry, why don't you and everybody else write a small Python program to implement just this? I mean, I can give the program to you easily. I hope I have not given it to you already. But yeah, just write a small Python program and implement this. But let's get back, right? The way you got the option value, you can make the variable as I mean, you can say that you can go to the screen price here. You're getting 32.1, right, 19, right? But look at the screen price. The screen price is totally different for 3,800 strike. For 3,800 strike, which is there in, what is the screen price? It is just 9. Now this is for what strike? This is for 30 12. There's 13 days. So your answer may actually reduce a little bit. So that's the thing. Like as the time reduces, the option value will reduce, right? So it will reduce a little bit, but still there's a gap, right? So you can play around with this, and you can also play around with the fact that, like, suppose you were to take this screen price of 9, the screen price of 9, and exactly for 14 days or 13 days, what should be the volatility number that will give it to you? See, although there are 5 variables that are affecting the option price, as you play around with this, you'll find out that volatility and time to maturity are by far the biggest ones, influencers. Okay, so play around with it. But what I want to mention is that, implied volatility is what drives the markets. Implied volatility reflects the inherent supply demand, everything that the Black-Scholes equation is not reflecting. And all traders are doing is, they're trying to find out, the sensing out, what the implied volatility levels will be. Okay, shall I move on?
So just a question.
Yeah.
So when Black-Scholes came out with this model, did they test it out on the market by trying to outperform the market with their model, or did someone try to do that?
Yeah, hundreds of times. So see, till the 80s, Black-Scholes was the only game in town, right? When people, of course, had improvised. Now you've got Nassim Taleb, who's, done lots of fantastic things. And when you say outperform the market, what does it really mean? Tell me, what does it mean?
So I'm trying to say is that, let's say out here it's marked as 9, and let's say they get an answer of 32.19, and they try to take advantage of the fact that there's a difference in the two.
Yeah, but so the big elephant in the room is volatility, right? I have just used the volatility number here. What people do is calibrate models. Okay, so I've just taken a volatility number here, 46%. People calibrate models, running it hundreds of times, depending on the market behavior. It's as if you are planting a tree, right? And when you plant a tree, or when you're creating a model, that model has to be calibrated. And how do you calibrate the model? You'll run it hundreds of times, use different parameters, and then you get a sense of what is the range for sigma. I've used 12% over here, but what if the borrowing cost of this person is, although it doesn't change that much. So there are these factors that come into play, and people make money not just by Black-Scholes. I'll come to that. People make money by totally different route. Okay, so and that's the kind of the bhakri pitla and bread of butter of what option traders do. Okay, so let me come to that. Mispricing of volatility is a big source of returns, but beating the markets is something, is a completely different thing. Beating the markets is, when you have, what are you beating against? Suppose how many of you are investing in mutual funds? Anybody raising hands? Lots of you are in. So I hope all of you are investing using the direct route, or are you using the regular route? Many of you are not aware also, right? That there's a difference between direct and regular. Are you aware?
So, like, customizing your own portfolio by yourself, is that you're saying by indirect route?
No. So what happens is, the person who sold the mutual fund to you, that person, may be a broker. And if somebody has sold your mutual fund, then actually it is very highly likely that that person is making 80 bips out of that sale as an annuity for them. But if you go to a direct route, you can go to the mutual fund company website anywhere and then just say, I want to buy a mutual fund. You can buy it and you save 80 bips. Okay, so if you're not, change your funds and say bye-bye to your broker. Anyway, that's a digression. But an important digression, hopefully, that will save some money for you. The main thing is that when you are investing in a mutual fund, the mutual funds give you a comparison of what they are doing against a benchmark. that is when you say that you are outperforming the benchmark, because you are comparing apples to apples. But here you have got nothing to compare really, right? You are wanting to make money as a trader, you are wanting to make money as an investor, and you want to know, how you know it is. So there are different routes to make money, not just depending on Black Scholes is giving a formula, like Harry Markowitz or others. They're saying that this is what it is. So for example, those who have done fundamental analysis, that the stock price is nothing but you can calculate the expected return of a stock price, right? What is the expected return of a stock price? Anyone?
So we can use the kappa model to estimate it.
Yeah, but what is it? Expected return is equal to
RF plus beta RF minus RM.
right.
Risk
So that's
mix.
although I don't know if you've played around with the formula to really understand what the formula means, but that's what it is. It's a simple looking formula. Does it have flaws? Hundreds of them. Does it work? Sometimes it does. How will you use it? You use it as a benchmark. You use it to know that, oh, the screen price is 9 and I'm getting 32. There's something wrong. Find out what is wrong. And that's when you start making money. Not using otherwise, if life were as simple as like take a formula, use it, everyone would have become rich, right? Shall we move on? Guys, shall we move
Yes,
on?
sir.
No, good. Good that there are questions coming. At least this is something I'm happy that it's probably useful. So let's we talked about what is the implied volatility. So try this as an exercise, because we are not even we have not even begun today's lectures actually, the lecture session. So solve this. Try to get an implied volatility number. But let's now go to option strategies. That's how people make money. So to recap, right, this is the call option chart. And by the way, these charts are generated, everything is generated using Python. So I'll send you a set of scripts, which will also allow you to calculate. I don't like this, but I'll be spoon feeding you. I would have liked that you write the formula yourself in Python so that you can become an expert one day. But anyway, so this is generated by Python thing. And what you can see here is that this, all of you understand. Any questions on this graph? Like it has got out of money, at the money, in the money. Any questions here? Anyone? It's a simple payoff diagram. Any questions?
No, sir, no question.
No, sir.
Yeah. So let's move on. The call payoff is slightly the call payoff is this way, and the put payoff is this way. Like you got on this side, it's kind of not symmetric exactly, but puts make money when the stock prices go down. So let's go to the option premium. No, the like Shubham, or I don't know who asked, maybe Ali asked that question. So he was the option seller, and an option seller wants something to sell that option to me as an option buyer. So what does this slide over here is just dissecting the option premium. It is dissecting the option premium into two halves. The first, not exactly half, but two parts. The first part is time value, and the second part is intrinsic value. Okay. So what is the time value of an option and what is the intrinsic value? Imagine that TCS stock price right now is 3,600. Okay, the TCS stock price is 3,600. And let's say the option premium is the stock price is 3,600 and the strike price was 3,500, right? So 3,600 minus 3,500 is 100 rupees, right? So if Ali, you were to sell the option to someone else, what would be the minimum value of the option that you would sell?
So the current market price.
No, what is it?
Sir, I didn't catch it.
So the
I actually
stock
catch it.
price is 3,600.
Mhm.
The strike price is 3,500. I come to you and I want a call option. So for that call option, how much will you charge at a minimum? Anybody else? I mean, it doesn't have to be Ali. I'll repeat again. 3,600 is a stock price. 3,500 is my strike price. My option is expiring on, let's say I come to you, any one of you, and I want a call option. I want to buy a call option which is expiring in 1 month's time from today.
So it would be 100 rupees, the difference between the strike and the current price.
and
Yeah.
and also the time value of it.
Right.
For the
Right. So
Correct.
you can see it is intuitive, right? You can see it is intuitive. At a minimum, the difference between the strike price and the absolute value of that, I mean, only if the in a call option where it is greater, that is the real intrinsic value. You have to charge that much. Otherwise, you can't. I mean, it will be foolish. And then plus you have to hedge that. Oh, what if the TCS moves beyond the 4,000 rupees? Now, suppose somebody, some person came to you and whispered in your ears that, you know what, TCS is definitely going to be 4,000 rupees in January 15th. How much will you charge now?
So 500.
Why 500?
Because in my mind now, the stock is worth 4,000 rupees, no longer worth at 3,600.
But this
For the
thing is
current price.
3,600.
Yes, but now I am anticipating the price to be 4,000 in Jan, right? So although the intrinsic value remains the same, I imagine the time value has increased a lot. Although although the although there is although this is not the exact meaning of time value, but if I know that the price is going to be 4,000 1 month down the line, then why would I sell it at just 100 rupees?
So is anybody there debating this answer? Like, do you want to up the bid? Like, I want to see, who's the maximum seller and minimum seller. So Ali, I think Ali was, what is the bid? This really happens. This is how a market is made. I'm asking the class, Ali is selling me an option on TCS expiring on Jan 15th and he's selling me at 500 rupees. Anybody else who's going to sell higher or lower? And if so, why? Think about it. Can somebody come forward? Anyone?
Sir, why are we not here considering the volatility?
No, I mean, I'm saying like you can consider you can presume you're not even talking about equations or numbers. Just asking, like Ali gave a answer response. I said that somebody came to Ali and saying that minimum it is going to hit 4,000 in a month. So Ali said, now I'll charge 500 rupees. How much will you charge, Prasun?
No, sir, so if the volatility is low, if I'm expecting that, I will charge less than that.
But somebody is giving you for sure certainty that it is going to cross 4,000. Volatility कैसे आएगा बीच में? Like for the minimum level, volatility will be there, will have a role to play. But I just want to, as
Can I add to
shopkeepers.
this? I actually have a doubt.
Yeah.
So, like you said, if I know for a fact that it's going to be 4,000 1 month down the line,
Yes.
but this information is restricted to me, right? This information
Correct.
is not yet public.
Correct.
So even though I'll actually open a position to sell this, nobody will actually, buy this option at 500. So I don't see any logic in even opening this position, because for the market, this thing is still worth 100 rupees. But for me now, it's worth 500.
Sorry. For the market also, suppose Ali, like the entire class knows now, it is going to reach 4,000. So what will be the minimum call option price?
Sir, in that case, I imagine the current market price will immediately shoot up to something that is really close to 4,000 minus the time value.
The stock price itself will shoot up, correct?
Correct, yeah.
Now, if the market knows that it is going to be 4,000, the market is not going to wait for 4,000 to happen in 1 month's time, correct?
It'll probably reach 3,900 in a minute.
Immediately, right? It will probably reach immediately. And what will the market do? The market will say, oh my God, it is not only going to remain at 4,000. There's going to be euphoria. Yeah. And the market will probably cross it at 5,000. Now, you as the option seller, you will be dead. If you were to sell an option, at that price, right? So you may want to ratchet up your own price.
Correct, sir. Because
Right.
again, there is an element of irrationality, what people say.
Yeah, irrationality. But be that as may, I wanted you guys to think about it. So I think you are now a little bit clear on both time value and intrinsic value. Can we say that?
Yes, sir.
Yeah. So let's move forward now. Now we go to option payoffs, right? So I'm just saying like two very, very simple options, right? Call and put. Nothing complicated here. Just the calls and puts. So it is, you can actually derive this. So if you're a long call, what is the value of the long call? The current stock price minus the strike price. That's the maximum you make. And zero is the other thing. If you go negative, you don't make anything. And similarly for a put, what happens is put starts making money when the stock price is below the exercise price. So that Oh, was I talking with myself? Were you able
Yes,
to
sir, we
hear me?
lost you. No, sir,
We
we lost
lost
you.
your
Sir,
audio.
we lost you for 5 minutes.
Okay. Where was I? So we were talking about call put parity, right? You can see my screen.
No,
No,
sir, no
sir.
No,
longer
sir.
visible.
You can't see my screen. So one second. Thank you to Geo. I lost everything. So the put call parity, this one, I talked about this, right? No matter what, this equation will always stand. And what it is saying, it is called as the put call parity. Did you guys did you listen to this, or I'll explain it again. Should I explain this again?
Yes, sir, we missed this entire part.
Yeah, okay. So what I'm saying is that unlike the Black-Scholes equation, this put and call parity always stands. And what does it mean? It means that you buy a call and you sell a put, And how are these calls and puts there? The strike price is the same. Okay, the strike price is the same, the maturity is the same, the maturity period is the same, and the same stock, of course, the same stock, the stock is the same. So all these three parameters, you buy a call and you sell a put, and if you do that, then this has to stand. The difference between the values of the call and the put is nothing but the difference between the current stock price and the strike price. Okay, the strike price and the time period, if the things were kept in this time period. All I'm saying is that you can go to the screen and find out discrepancies that do not match, that do not equate this. So if this is more, you can then this, then you can sell one and buy another, is what I'm saying. You can actually do that, because unlike Black-Scholes, this is an axiom, okay, which stands. That's the only thing that I wanted to say. Is that okay? Hello?
Yes, sir.
Yeah.
Sir, I have a question on this.
Yeah.
Not on this actually, a more generic one.
Yes.
So like we learned all these, volatility, all these terms and all. My question is about the reliability of any model that we build, because I imagine back testing would not really work for anyone in any market scenario, right?
Right.
So how do traders actually test the accuracy or the reliability of the model in general?
Yeah. So this is a good question. Who was it?
Ali, sir.
Yeah. So Ali, what you have to do is that, in fact, I mentioned implied volatility, right? So when
Okay.
I was on the trading desk, what I had to do, when I joined the trading desk, they always give you some tasks such as bring me the coffee, bring me the tea, and you're the junior person, right? So you have to do all those things. And one of the junior tasks is to create a volatility surface. Now, what do I mean by that? You take the model, you take the Black-Scholes model for whatever it's worth, and you try to find out the implied volatility for a range of values, for a wide range of values, strike prices and maturities. And then you get a actual volatility surface based on the model that you've got. And you do that for a range of instruments. And when you do that, you calibrate important values. What are the values that you actually calibrate? You calibrate even the rate R, okay, the interest rate R. You also calibrate the volatility value. So you create a volatility surface going forward. What is this saying? These instruments which are at different maturity, right? These are instruments at different maturity. They are not at one maturity. They are at, like, you can go here itself, you can see maturity till February. And there'll be index options where the maturity will go beyond that. So all you can do is you can take all of that and create a different volatility surface. And why am I calling it a surface? Because it is multidimensional. It is across time. You are getting a bunch of volatility values across instruments and across time. So now once that is there, you've got your calibration. This is what you've used the model for, whatever it's worth, right? And it's been used by everybody. Now this model is throwing up volatility values based on actual prices. Now you take these volatility values and you start pricing your own options. Got it?
Sir, I get that part, but see, to be honest, what I did was a couple of days back, I had actually gone through so I actually visited the NSE site
Yeah.
and went to the equity derivative segment. So over
Right.
there, what I was monitoring was the open interest. So it seemed it's it's not only on a daily basis, but even within the hour, the way this open interest shifts from one price to another, it's really fast. So I was not able to even get an idea as to where the market might just go in the next hour or the next 2 hours or so.
Right. So you're talking about next hour or next 2 hours. I think you're already thinking like like an algorithmic trader. You won't be able to think that fast. You'll have to have machines to do that. So, but that's a different, algorithmic trader. The trader doesn't see this. They actually go and look at the trades, in underlying trades, and find out microstructures that comprise those trades. All you're concerned about, Ali, is that why is the first of all, I mean, let's not even go to the derivative side for NSE. Let's look at just normal stocks. Okay,
correct.
just normal stocks. Are we able to look at the normal stocks and find out why is the volume there in a particular counter and why it is not there in a particular counter? Why is it suddenly there? Why is, I mean, the way it starts for thinking like a trader. The first exercise you should do is go back, and we are now digressing from the topic. Go back for a month and explain for one single instrument, just one
Okay.
single instrument, let's say TCS or any other instrument.
Mhm.
Explain for 5 years why the prices has gone up, prices has gone down. Explain every single event. So this is what they will ask you to do when you join a desk. Go and look at the chart, print out the chart, and tell me, you have to know this precisely, why it has gone up, why it has gone down. That's your homework. Now, in doing that homework, because price is the ultimate expression of what that company is doing, right? It's the expression. It's the
Correct.
expression of the fundamentals. It's the expression of supply, demand, everything. Now, once you know that, you know everything about the company. Now, I mean, not everything, many things. Now, similarly, you have to apply the same logic to the options market. For the options market, you don't have to actually, I mean, you don't have to do this to study the options market. You don't have to do the stock market. But many times for single stock options, this is what you end up doing with. If you are doing index options, then index options are far easier. Index options explain the value for index for the last 6 months, 1 year. It won't take more than a day. It may not be correct, but you'll get somewhere. You'll get to know the highs and the lows, and you'll have news flow and then your own explanation. Explain the changes in volume. Now go and look at the index option prices and just take one maturity and one strike, let's say 15% out of the money, right? Or 5% of the out of the money. There are different strikes, so it's not all very uniform. It's So you have to take just one maturity, like let's say 1 month maturity, and let's say 10% out of the money. Then compare why this 10% out of the money is there and how the OI, the open interest, has changed for that. That will tell you a story. Now, what you don't know is that the Indian market is, it has got full of speculators, arbitrageurs, and hedgers as well. And what happens in the Indian market is that people have that they have this habit of have this habit of scalping, and they are daredevils because they lose their shirts and bunions and pants also sometimes, but they don't. It's a quirk of the Indian market that they start to make money when the market is soft. And how do they make money? They make money, instant money, by selling options. And as you know, as we saw till now, right, selling options is probably one of the most dangerous things. Can somebody tell me why?
Sir, because if you lose, you lose a lot.
Sorry?
Sir, because if they are exercised, you are doomed basically. You get instant cash, but the
Exactly.
payoff is
So
You
because
get,
your upside
yeah,
is limited,
yeah.
but your downside is unlimited,
Yeah, so
basically.
so so you get instant gratification by getting cash, and you think, "Arey, Nifty ka kuch nahi hone wala," and event comes once in 4, 5, 6 months, and it just puts you out of business. So there have been, like, the stories abound on how the markets, and people like to bet. Why do you think, I mean, I'm against stock exchanges coming out with weekly. Why do you need weekly options, weekly settlements? It's kind of helping speculative behavior. Be that as may, to answer your question, there is no simple answer to why a particular equation may work, and how will you explain that. It's a whole business. Maybe you may find anomaly, Ali. You may find anomaly, and you may say that, like I said, like, the stock option price for TCS 3,815 days, and maybe 5%, 10% out of the money is way off than what you got from Black-Scholes. But we are not really calibrated our Black-Scholes. We've not used our estimate. I mean, change this value, and you'll see how this, and draw a graph of the change in volatility that you give and the change in the option value, which, by the way, is the option Vega. So the Vega will wobble all around the place, as you change the volatility values. In fact, it's one of the most sensitive things. Uh, so it's not a straightforward answer, Ali, unfortunately, but it's a start. Try something, try things out, And the best thing to try is not just analyzing what is happening. Buy something, buy an option, sell an option, get a feel of the heat that comes through that trade. And when will you feel that heat? You'll feel that heat not when you are making a profit. You'll feel that heat when you make a loss. Okay, so let me continue, Ali. Is that fine?
Yes, sir.
So the delta of the option is the sensitivity of the stock price to sensitivity of the option to the stock price. It's simply d of the C, the call, d of C divided by d of the stock price. And as we saw, this delta is nothing but what? This delta is nothing but the probability that the option will be into money, right? And we saw that it was nothing but n of d1. Do you remember this from the Black-Scholes formula? Do you remember this part? That it's the n of d1. Anybody who's not remembering this?
So the spot is only on the first term. Yes.
Right?
Because the second term has the k minus e power rt.
Yes, correct. Yes, correct. And that is nd2. So there's nd1, nd2. Okay.
Yes.
So,
sir.
and then what we saw, it is nothing but a combination of the intrinsic value plus the time value. And then there are calls. The value of the calls, the value of the delta is between 0 and 1. Why? Why is that? Why is the value of a delta between 0 and 1? What will happen if the delta is above 1? What is the formula for delta? The formula for delta is a change in the sensitivity of the option, the change in the value of the option divided by the change in price. Right? So if the value of the delta is above 1, what will happen? Suppose the value of the delta is 2. Okay. So now, so if the, just sorry, 1 second. Just 1 second. Sorry. Sorry. Sorry, I need to handle something. Yeah. So suppose the value of the call option is 2, right? And value of delta is 2. Now, if the value of delta is 2, what happens is, what will happen? It means that if the stock price moves by 1 rupee, if the stock price moves by 1 rupee, my value of option will move by how many? It will change to 2 rupees, isn't it?
Yes, sir.
Yes, sir.
But if my stock price is just moving by 1 rupee, correct? So if my stock price is moving by just 1 rupee, it is there'll be arbitrager upon. There will you as an arbitrager will make a profit, right? How is that possible? It's impossible or implausible, right? Do you get it?
So not entirely.
So suppose, why the value cannot be above 1, because suppose the value is 2, the value of the delta is 2. What does this mean? Suppose you are selling, will you ever sell as a shopkeeper, will you ever sell this option? Such an option which has got a delta of 2. Because I'm buying it from you, I'm buying that option from you, and I'm going to profit like anything. That delta is moving at twice the speed, right? It is moving at twice the speed of the stock. Everybody is going to buy from you and you'll become bankrupt, right? Because you sold a call.
Yes.
Let's not even go into the formula. So you sold a call which has got a theoretical value of 2. Now, I know about it. Shubham knows about it, Cherry knows about it, 10 other people know about it. They'll say, "Arey, this shop is selling an option which is, running twice as fast as the underlying horse on which it is running." So the horse has run one round of the race course, whereas your option is so magical that it is giving me twice the benefit of one round. You get where I'm coming from?
Yes, sir.
So you will stop selling such an option, right? Otherwise, you'll go bankrupt,
Right, sir.
right? So that is one logical reason why it will never be more than one. Now the second answer really is, remember that it was ND1. It is just a probability with maximum variance of 1, mean of 0. Correct? It's a probability value, and probability is always between 0 and 1.
Yes, sir.
Yes, sir.
Right? So that's the main reason for it's not the main reason, but you think about things intuitively. Like, can this happen? Can this happen at all? But anyway, so let's go back to this. I'll erase this. Why is that? I can't erase this. Anyway, I can't erase this. But now let's go to the next one. The next one is this terminology: far in the money and far out of the money. So when a call option is far in the money, right? Ali, you sold that option to me, and I keep on going to Ali because he first of all offered to sell. So Ali has sold his option to me. TCS was trading at 3,600, and he sold the option to me where the strike price is 3,500. Now, would you call that option far in the money?
Sir, your voice is breaking. We can't hear you.
Can you hear me now?
Yes, sir, it's fine.
Yeah, so Ali has sold an option which is with the strike price of 3,500, and the current price is 3,600. So is this option far in the money?
Sir, not far in the money.
So how much will be far in the money?
Around 3,000.
What do you mean? Like, the strike price is 3,500.
Yes, the exercise price is 3,000. If
And
it
stock-
is, if it
Sorry?
is, then if the strike price is 3,000 and the stock price is 3,600, then we can say that. it's
Okay,
far
fine.
in the money.
Let's take your case. Sorry, who is this?
Prasoon.
Prasoon. Let's say that 3,000 and 3,600. Now you're happy it is far in the money.
Yes, sir.
Now think of a mental exercise. Prasoon, you sold that stock to me. What should be the delta of such a stock? Delta can't go beyond 1, right?
Right, sir.
So it has to be very near 1. It is not exactly 1, but it is very near 1, right? Because it is, my call option is going to now act almost as if the underlying stock. Stock moves by 1 rupee, call option moves by 1 rupee. Stock. Otherwise, what will happen? Suppose, do a mental exercise. You sold that stock to me, let's say for 800 rupees. 3,000 is the strike, 3,600 is current price, and you said that you sold it for 800 rupees. Now, if your price, if the option doesn't move along with the price, suppose the option stays as it is, right? 800 stays as it is, the value, but the stock price moves by 100. What will happen? The option will start becoming cheaper, right? So now the stock price has become 3,700, and you sold it to me for let's say for 800 rupees. Now it is already 700 rupees in the money. But now your risk is that it could go through 4,000, 4,500, and so on. So your call option price also has to jump and gallop along. And what is that rate that it is galloping along? It is almost equivalent to the rate of the underlying price, stock price. You get it now intuitively? So as soon as the call option goes into money, right, goes far into the money, just to catch up with the stock price and just to make sure that the seller of the call option doesn't lose out. You know, the call option price, the buyer of the option in this case, doesn't lose out. It is in the money. It's far. It's a property. It's far in the money. It's very near one. Sorry, that's a property. And when it is far out of the money, when the call option is far out of the money, suppose Prasoon sold me a stock option for 3,000, let's say for 4,000, 5,000 strike, 5,000 strike. Current price is 3,600. Expiry is end of the month. There is no chance that it's going to cross 5,000, right? Unless TCS starts to rain gold. So my probability now becomes zero, right? Almost zero. That's the meaning of far out of the money. And this is the meaning of far in the money. Everybody with me? Hello?
Sir, I
Hello?
get this part.
Yeah.
But again, for options that are far in the money, like you said, there is also an element of time, like you said, right? It's going to be 1 month down the line.
Right.
So if there is a certain expectation of something negative happening after a month or after 2 months, won't options that are far in the money still have a lower delta than one?
Correct. So then their deltas will be relatively lower. You're absolutely right. So I'm just giving you some rule of thumb rules. Sorry.
Okay, got it, sir.
Got it. So
Yeah,
now
yes.
let's go further ahead. Actually, I've got an appointment coming up soon, but we'll cover things tomorrow. So tomorrow, what I'll do is, there's a lot of slides actually. There's at least 15, 20. We have not gone into delta hedging. Okay, so what I'd like to do tomorrow is, please review these things. And how will you review it? You got the lecture online, so you can actually review at least today's part, right? Today's part has become interesting because we not only revise what we did yesterday, we also have started going into the basics of options. What we'll do tomorrow is that we'll cover the delta hedging part. We'll cover other Greeks as well. There's gamma, there's theta. That's a minimum that we need to cover, and we'll then cover delta and gamma hedging, and then what we'll do is we'll look at a little bit of Monte Carlo simulation, and I'll do some visualizations, and we'll close out there. Is that fine?
Yes, sir, works.
So tomorrow I have a request. Can you make the time as 10 o'clock instead of 9:30?
So you have to. Yeah.
Sir?
Sorry, I thought it was. So we can join in a bit late. We can announce it in the class that the class is from 10 o'clock.
Oh, you got a class from 10 o'clock?
So no, we can announce it on the class group that this class is from 10 o'clock tomorrow.
So as long as you don't have anything at 12 o'clock or 11:30, if you could do at 10 o'clock, because there's a commitment coming up for me. If at all you can shift it to 10, I can start at 10 and we can go to 12 or whatever, like afterwards.
So we have a class at 11. Some of the students have the class at 11:30, linear economics class.
Oh, you got a class? Then let's do it 9:30 itself. That's fine. We'll start at 9:30 itself. So I guess many of the students would have left already, right? It's 11:40 now.
Sir, I think most of us are still here.
Sorry?
We'll announce it to the class that we'll just announce it to the class that the session is going to be at 10 o'clock.
Fine then.
Sorry, at 9:30. Sorry.
So whichever time you would prefer, so 9:30 or 10.
No, 10 o'clock is preferred for me tomorrow.
So maybe tomorrow we can do from 10 to 11:30 if.
That's fine. Yeah, we
Yeah.
can go on till 12. I don't mind. I don't have a problem later on. It's just till from if I could do 10 o'clock, that will be great.
So because actually there are, most of us have not taken the subject, but a few of us have taken linear economics, like I think Cherry and all. So that might be clashing.
Then we'll do at 9:30. No problem. We'll do it at 9:30, Neil. No problem.
All right, sir.
Okay. Yeah. So can Okay, so let me just complete this slide. So all I was saying is that this is like when you plot the delta of the stock against the stock underlying price, the moment, like, remember, this is the strike price, right? Let's say 15 rupees. So the moment this hits 15 rupees, it's the delta steeply rises, and then it remains kind of flat. This strike is 25, the delta steeply rises. This strike is 35, the delta steeply rises, and so on and so forth. So that's the only point I wanted to make. Okay, so see you tomorrow then. We'll carry on tomorrow.
Thank you, sir.
Sure, sir. Thank you so much.
Thank you. Bye.